Our next guest has some thoughts about this. He says that the S&P 500 is getting increasingly vulnerable to a meaningful sell-off. Joining us right now is Sam Stovall. He is Chief Investment Strategist at CFRA Research. Sam, what do you mean? What goes up must come down?
Good morning, Becky. Well, we had a very strong first quarter, actually ranked number 11 going back to World War II. And essentially what we find is that it does offer a running start into April as well as into the second quarter, where we've had an average increase that's better than the average for all years. But what it does imply, though, is of these top 15, 13 of them experienced declines of 5% or more along the way. So an intra-year decline, with the average being minus 11%. And then 8 of those 13 then had a second intra-year decline, which averaged 12.5%. So it could end up being a very volatile year, even though 14 of the 15 then ended with double-digit gains for the entire year.
Oh, my gosh. So buckle your seatbelt. You're in for a potential roller coaster ride.
Exactly.
When did these things take place? Can we put it into any historical context, what was taking place at the time?
Well, you go back to 1975, so right after the 48% bear market triggered by OPEC. 1987 was the only observation in which we had a single-digit advance. 1991, so right after the Gulf War, and then also 1998. These are the top ones that I'm reading off. So that was during the height of the dot-com bubble. So depending on whether we are coming out of a bear market environment, we've been in one, or coming into a stronger bull market kind of an environment, I would tend to say that the real question is, what is likely to be happening based on interest rates, economic growth, et cetera?
Sam, we were just talking gold. You've got some thoughts on why gold is behaving this way, hitting these record highs. What's up?
Well, I think that hitting record highs, first off, because of the prospect of lower interest rates. Certainly, I hate to admit this, but I might be agreeing with Joe in that maybe if we have the possibility that the Fed will be slower to lower interest rates and that we do end up with 2 or even 1 rate cut after the election, then I think that could cause investors, that would be the trigger or a catalyst for a correction. But I think gold has been benefiting from lower interest rates, increased tensions in the Middle East, central banks increasing their purchases. And I also think that we're seeing a slight improvement in the Chinese economy. And that has been propelling gold prices. And I think we could have a target of about $2,600 an ounce.
Okay, I'm with you, Andrew. With Sam's record, if he now agrees with... If he's, I'm with you. I don't want him agreeing with me.
You're coming to me?
Yeah, I'm coming to you.
Goodness.
With what I've seen from Sam over the years. So you lost me now, Sam.
Sorry, Joe.
That's okay.
The tech trade, big questions about whether it's a tired trade at this point, whether it can continue and AI push that forward. What do you think?
Well, I think that we are going through a digestive phase right now in tech because tech has done so well. Yet still, along with communication services, financials, it's posted a double-digit first quarter gain. And history says that following up years, you want to let your winners ride. So while we could end up seeing a correction in time, maybe even slight noise, if you will, meaning a sub 5% decline in this area, I would tend to think that tech is likely to be an outperformer when 2024 comes to a close.
You're still looking for 3 rate cuts, though, from the Fed?
Right now, that's what we're looking at, sure, and it's starting in the June timeframe. Obviously, everything is data dependent, even our own forecasts.
But yesterday, the market, I think, kind of bet with its feet and is pushing that off as a less likely scenario.
Yes, but if you look today, we're looking at about a 58% chance that the Fed will actually start in June. So right now, I think it's a toss-up between the first rate cut occurring in June or July. Certainly, the closer that we get to the election, could be a real question as to whether they want to start it in September, just before the election. Every election year since 1992 has had a change in Fed policy, except for 2012. So it is not unusual to have the Fed make monetary moves in an election year.